Imagine a world where borrowing becomes cheaper and spending becomes more appealing. A world where the growth of businesses is stimulated, job creation is enhanced, and consumer confidence is boosted. This could be our world in 2024, as top economists predict a significant move by the Federal Reserve. Intriguing, isn't it? Let's delve deeper into what experts say about this. Interest rates, to put it simply, are the cost of borrowing money. They represent the reward for the lender and the cost for the borrower. In essence, they are the price tag on money. The Federal Reserve, America's central bank, uses interest rates as a tool to control inflation, stabilize the economy, and influence countless financial decisions. Now, after a period of raising interest rates, the Federal Reserve is expected to shift gears. According to economists at major North American banks, the Fed is poised to cut interest rates by about 1 percentage point in the coming year. This could be a game changer for the economy and for investors. Lower interest rates can stimulate borrowing and spending, leading to economic growth. They can make it more affordable for businesses to expand, for homeowners to refinance their mortgages, and for consumers to make major purchases. All of this can contribute to a robust and thriving economy. But remember, these are predictions, not guarantees. The market is a complex and dynamic system, influenced by a myriad of factors. While economists can make educated guesses based on trends and data, the future is always uncertain. So, what does this mean for you? Whether you're an investor looking for opportunities, a business owner planning for the future, or a consumer contemplating a major purchase, these changes in interest rates could have significant implications. Understanding these potential shifts can help you make more informed financial decisions. Intriguing, isn't it? Let's delve deeper into what experts say about this. Influential economists have made some fascinating predictions. This isn't just any speculation, but insights coming from the chief economists at some of the leading North American banks. These experts have their fingers on the pulse of the economy, and their words carry considerable weight. Turning our attention to the coming year, these financial wizards foresee a significant shift in the Federal Reserve's strategy. After a period of steadily increasing interest rates, the Fed now appears ready to close this chapter. The anticipated next step? An about-face with a reduction in interest rates. These economists predict a notable cut in the interest rates by approximately 1 percentage point, all set to unfold in 2024. So, what's behind these predictions? The reasons are multifaceted. The Federal Reserve uses interest rates as a tool to manage inflation and stimulate economic growth. When the economy is robust, the Fed might hike rates to keep inflation in check. Conversely, in times of slower economic growth or a recession, the Fed could lower rates to stimulate borrowing and spending. However, it's not just about economic cycles. Many external factors can influence the Fed's decisions. Geopolitical events, fiscal policies, and global economic trends can all play a part in shaping the interest rate landscape. But why a rate cut now, you might ask? Well, these economists suggest that despite the recent period of rate hikes, the Fed may be responding to signs of economic slowdown. By lowering rates, the Fed could be aiming to stimulate borrowing and spending, thereby fostering economic growth. Remember, though, these are predictions, not certainties. The economy is a complex beast influenced by a myriad of factors, both domestic and international. Predictions can offer valuable insights but should not be mistaken for guarantees. However, if these predictions hold true, the implications could be far-reaching. Lower interest rates can make borrowing cheaper, stimulating spending, and potentially spurring economic growth. This could impact everyone from big corporations to small businesses and individual consumers. So, as we move forward into 2024, keep an eye on the Federal Reserve's actions. Whether you're an investor, a small business owner, or just interested in the economy, these anticipated changes could have a significant impact on your financial future. And there you have it. The future of interest rates as predicted by some of the top economists in North America. A potential shift in the Fed's strategy could be on the horizon, with a rate cut expected in the coming year. This is the kind of information that can help you plan ahead, make informed decisions, and potentially take advantage of changing economic conditions. So keep your ear to the ground, follow the Fed's actions closely, and stay informed. If these predictions hold true, the implications could be far-reaching. The future of finance is always evolving, and the savvy observer will be ready to adapt with it. Now let's discuss what this could mean for the economy. By lowering interest rates, the Federal Reserve is essentially making money cheaper to borrow. This could encourage businesses and individuals to take out loans, thereby increasing spending in the economy. After all, when money is inexpensive to borrow, it's easier to justify making larger purchases or taking on new projects. Let's consider the potential effects on businesses first. When interest rates are low, businesses might be more inclined to take out loans for expansion or capital improvements. This could lead to increased production, innovation, and even job creation. Corporations might also be more likely to undertake mergers and acquisitions, which can lead to further economic growth. But the effects aren't solely confined to businesses. Lower interest rates could also stimulate job creation in a more direct way. As businesses expand and grow, they will need more employees. This could lead to a decrease in unemployment rates, which would further stimulate the economy as more people have income to spend. Furthermore, with lower interest rates, governments can borrow more affordably. This can result in increased spending on public services and infrastructure, which can also contribute to job creation and economic growth. However, it's important to note that while lower interest rates generally stimulate economic growth, they can also lead to inflation. If the supply of money increases too quickly, for example, if too many people and businesses are borrowing and spending, the value of money can decrease. This can lead to rising prices or inflation, which can erode the purchasing power of consumers and businesses. Additionally, while low interest rates can stimulate borrowing and spending, they can also discourage saving. After all, why put your money in a savings account, earning a low interest rate when you could be investing it elsewhere? This could potentially lead to a decrease in the overall savings rate. In summary, while lower interest rates can certainly stimulate economic growth through increased borrowing and spending, they can also lead to inflation and a decrease in savings. It's a delicate balance that the Federal Reserve must strike, and it's why their decisions are watched so closely by economists, investors, and businesses alike. So even though we can't predict with absolute certainty how these expected rate cuts will impact the economy, we can make some educated guesses based on historical trends and economic theory. It's clear that the ripple effects of these rate cuts could be significant. As with all things economic, the actual implications will depend on a multitude of factors, including how businesses, consumers, and governments respond. But one thing is for sure, whether you're an investor, a business owner, or simply someone who's interested in the economy, it's important to keep an eye on these developments. The ripple effects of these rate cuts could be significant. But what does this mean for you as an individual? Well, let's delve into that. The predicted rate cut could have a considerable impact on your personal finances and future financial planning. Lower interest rates can make borrowing more affordable, which could potentially lead to lower mortgage rates and more accessible financing for big-ticket purchases. Imagine you're considering buying a home. With lower mortgage rates, your dream of homeownership could become more attainable. You could secure a mortgage with a lower interest rate, which can result in reduced monthly payments. This could free up more of your income for savings, investments, or other expenses. Or perhaps you're an entrepreneur looking to expand your business. Lower interest rates could make it more affordable to borrow money for business investments. This could be the golden opportunity you've been waiting for to take your business to the next level. Even something as simple as financing a new car could become more accessible. Lower interest rates could mean lower auto loan rates, making that shiny new vehicle within your reach. But it's not just about borrowing. Lower interest rates could also potentially impact your savings and investments. If you have money saved in a high-yield savings account or certificate of deposit, lower interest rates could mean lower returns. However, this could also present an opportunity to explore other investment avenues that could potentially offer higher returns. And what about your retirement plans? Lower interest rates could affect the growth of your retirement savings. If you're nearing retirement, this might be a good time to have a chat with your financial advisor to discuss potential strategies to mitigate any impact on your retirement savings. Now, it's important to remember, these are predictions. They are not set in stone. Economic conditions can change rapidly, influenced by a myriad of factors, both domestic and international. That's why it's crucial to keep abreast of the latest developments in the financial world and make informed decisions based on your personal financial situation. So whether you're a homeowner, a prospective homebuyer, an entrepreneur, or an investor, the potential rate cuts could have significant implications for your financial future. It's certainly worth considering how these changes could impact your personal finances and future financial plans. Remember, every financial decision you make today can significantly impact your financial future. So take the time to understand these potential changes and plan accordingly. Consult with a financial advisor if needed to ensure you're making the best financial decisions for your unique situation. In conclusion, the potential rate cuts predicted by economists could have significant implications for individuals. From making borrowing more affordable to potentially impacting savings and investments, the potential benefits and challenges for individuals are certainly worth considering. So, stay informed, stay prepared, and make the most of the opportunities that come your way. The potential benefits for individuals are certainly worth considering. However, it's crucial to remember that economic predictions are not guarantees. Here's the thing about the economy: it's a living, breathing entity. It ebbs and flows, rises and falls based on a myriad of complex factors. Predictions, even those made by the most seasoned economists, are just that: predictions. They offer a glimpse into what might be, not a definitive map of what will be. This is where the importance of staying informed comes in. It's about more than just knowing the forecast. It's about understanding the climate that shapes it. It's about having a holistic view of the economy, from the micro to the macro, and learning how to read the signs and signals it sends out. Take the Federal Reserve's potential rate cut in 2024, for example. On the surface, it might seem like a simple, straightforward decision, but when you delve deeper, you'll find a complex interplay of factors at work, from inflation rates to employment figures, from global economic trends to domestic fiscal policies. That's why it's essential to follow reliable sources of information. These sources provide not just the facts, but the context in which these facts exist. They help you understand the why behind the what, the cause behind the effect. But staying informed doesn't stop at following the news. It also involves consulting with financial advisors, those who can take the raw data and translate it into a language you can understand. They can help you make sense of the economic landscape, guiding you on how to navigate it based on your specific circumstances. Whether you're an investor looking for the next big opportunity, a homeowner considering refinancing your mortgage, or a consumer trying to make sense of your spending habits, staying informed is key. It empowers you to make decisions that are not just reactive, but proactive. It allows you to anticipate changes, prepare for them, and even turn them to your advantage. And so we come back to the essence of our message. Knowledge is power, especially when it comes to navigating potential changes in the economy. So, there you have it, an insightful look into the future of interest rates. We've covered a lot of ground today, delving into the predictions of leading economists who expect the Federal Reserve to shift from a period of raising rates to a time of cutting them by about 1 percentage point in the upcoming year. This change in monetary policy could have far-reaching implications for the economy as a whole. Lower interest rates can stimulate borrowing and spending, potentially boosting economic growth. It's a scenario that could open up new opportunities for businesses, lead to job creation, and boost consumer confidence. But let's not forget the impact this could have on you as an individual. More affordable borrowing could mean lower mortgage rates, reduced monthly payments, and easier financing for those big-ticket items you've been dreaming about. It's a landscape that could provide new opportunities for homeowners and potential investors alike. However, we must remember that these are predictions, not guarantees. The economic landscape can shift, and it's crucial to stay informed. Following reliable sources and consulting with a financial advisor can help you navigate these potential changes wisely. We hope this video has given you a deeper understanding of the potential future of interest rates and the impact of the Federal Reserve's monetary policies. Our aim is to help you stay ahead of the curve, make informed decisions, and ultimately invest wisely. If you found this information valuable, don't forget to hit the subscribe button. We'll be delivering more insightful content like this, keeping you updated on the latest economic trends and forecasts. By staying tuned to our channel, you're taking a proactive step towards understanding and navigating the economic landscape. Stay ahead of the curve and make informed decisions by staying tuned to our channel. Until next time, stay informed and invest wisely.